Short exercise 5-5, journalize sales transactions with sales return and discount. Journalize the following sales transactions for Tiffany Sportswear. So we are doing the accounting here for Tiffany Sportswear. Explanations are not required. Assume the company uses a perpetual inventory system and records sales at the gross amount. So we can view the transactions here or as we go. So if we take a peek here, looks like on August 1st, we sold some sportswear on account. So that's going to give us some AR. Then we return some damaged sportswear. So then we are going to lower AR, accounts receivable. And then finally, the customer is going to pay us on the 10th, less the return and less the discount. So let's minimize this and get to August 1st. So Tiffany Sportswear sold 61,000 of sportswear on account. Credit terms are 210, net 30. Cost of goods is 32,000. So we have to begin by preparing the entry to journalize the sales portion of the transaction. Do not record the expense related to the sale. So that's the cost of goods sold. The COGS will come after. So we will do that in the following step. So what we are doing here is we are selling the sportswear that cost us $32,000 for $61,000. That's almost a 100% markup, so I like this business. And then remember, anytime we're selling inventory, we're going to have two transactions. This first transaction that we're doing here shows the sales revenue, and then the second transaction will show the cost of goods sold and the inventory. So we are selling this on account. So you'll see that on account right here. So are we getting cash? No, instead of cash, we're getting accounts receivable, which is an asset. So this asset, is it going up or down? It's going to be going up. So we're going to debit accounts receivable. And that AR is going up by 61,000. Then we're going to need a credit for 61,000. And do we have a sale? Yes, we do. So that means sales revenue is going to be our credit count, since that credit increases sales revenue, which will make it go up. Let's go ahead and check our answer. Excellent. Okay, now on August 1st, so we are journalizing the expense related to this August 1st sale. That cost of goods is $32,000. So we have to update our inventory and we have to update our cost of goods, also called cost of goods sold. So cost of goods sold, do you remember what type of an account that is? It is an expense. So remember that cost of goods sold is an expense that a lot of students forget, that this COGS, cost of goods sold, is an expense. So since we sold this inventory, do we have more expense or less? We have more expense. So we are going to debit COGS, cost of goods sold, for $32,000. And that is increasing our cost of goods sold. And then to balance transaction, we are also going to have a $32,000 credit, and that is going to be to our inventory, because remember, which way is inventory going when we sell it? It is going down. So that goes down with a credit because it is an asset, and assets decrease with a credit on the right-hand side. So whenever you have inventory, when you buy that inventory, it's an asset. And a lot of people think, well, if I'm going to sell it eventually, isn't that an expense? But no, it's not an expense until you sell it. So when we first buy some inventory, we record it as an asset. So that means assets are going up during the purchase, and then when we sell the inventory goes down. So basically we're transferring the asset from an asset to an expense called cost of goods sold. So our inventory never becomes an expense until we sell it, and the expense is called cost of goods sold. Let's go ahead and check that answer. Excellent. All right, so now on August 5th, Tiffany Sportswear received a $2,000 sales return on damaged goods from the customer. Cost of goods damaged is $1,050. Start by preparing the entry to record the sales return. Do not record the cost of inventory return with this entry. We will do that in the following step. So a sales return here means that we are the ones doing the selling and getting the return back to us. So that does not mean we bought it. We are returning it to our supplier. So the definition of a sales return is we sold it and our customer is returning it to us. So the best way and easiest way to think about this is we're going to reverse the sale. So the account that's going to be reversed, but instead of lowering sales revenue directly, we're going to keep track of the returns with an account called sales returns and allowances. Now, some of you might be saying, well, do we really need to track these sales returns? So my best example of why a company would want to keep track of sales returns instead of just lowering sales directly is, say, a student would go to Costco and buy a computer. Costco used to have a generous return policy of a year if you returned that computer within a year, and they would refund you your money, no questions asked. So the student would go buy a Costco computer, return it a year later, get their money back in full, and then turn around and buy a brand new computer, which would be faster because that's how computers are developed each year. They get faster. So with this result being he would each year turn around and get a free upgrade for a computer, what Costco did is kept track of their sales returns, and they noticed that their computers were being returned a lot. So what they did is they modified their return policy and said you can only return it within 3 months. So that cut down the costs of the returning or the customers returning their computers quite drastically. So that's why a company would want to keep track of sales returns. So again, when our customer returns some of our sportswear, we're going to reverse this transaction, but instead of reversing the sales revenue directly, we're going to use that account called sales return and allowances. So that is here. And so here is our expanded accounting equation, but this time notice I have some contra accounts down below. So we have contra assets, which is the accumulated depreciation. We don't have to worry about that for this problem. But here's our contra revenue accounts showing you the pluses and minuses. So remember up here, revenues increase on the right side and contra revenue means it lowers revenue. So its pluses and minuses are opposite. So when we record more sales returns, we are going to debit sales returns and allowances in the same way. When we have a sales discount, the sales discount is going to increase on the left side. But right now we're only dealing with the sales returns and allowances. So let's go back to our journal. Now, how much are we going to debit the sales returns and allowances? So now we were going to charge them this $2,000 for what they returned. So that's going to be going back to them. So in order to do that, we're going to need to debit $2,000 here for the sales returns and allowances. So again, this first transaction are the amounts that we were charging our customer. The second transaction is how much the inventory actually cost us. So that's going to be below. So then what is our credit account here? It is accounts receivable since they paid on account. We are lowering the amount that they owe us by $2,000. So you'll notice if we scroll back up in the sale, we are increasing the accounts receivable here since they are promising to pay us later. And then we are decreasing the accounts receivable here by the cost of the amount of the sales return. So now we are decreasing AR, so that customer owes us $2,000 less. So we're essentially reversing the first transaction here with the exception of sales revenue since we have to track those sales returns and allowances with a debit here. So let's go ahead and check our answer. Well done. Okay, so now we have to prepare the entry to record the cost of inventory return. Cost of goods damage was $1,050. So again, to review, going back up here to the second transaction where we originally sold this inventory and lowered it, we're going to have to reverse these two accounts, this cost of goods sold and merchandise inventory. So instead of inventory going down, it is going to be going up with a debit, and then the cost of goods sold is going to go down with a credit in this bottom transaction. So we're just flipping those accounts. So we have merchandise inventory for our debit since we're getting our inventory back, and then we are lowering our cost of goods sold. Those are no longer sold, they're returned to us. And that is by that cost of goods damage of 1,050. So again, we're just reversing the second transaction. Let's go ahead and check our answer. Excellent. Okay, so now on August 10th, Tiffany Square receives payment from the customer on the amount due, less the return and the discount. So here's the way I like to logic our way through this transaction here. So let's find out how much the customer owes us. So at the beginning of the problem, the customer originally owed us $61,000. So then let's take a look and see if accounts receivable was lowered here at any point. Yes, it was lowered here by $2,000 with a credit. So that means that the balance in our AR at that point would be $59,000. So again, that's that $61,000 that they owed us at the beginning, and then less the return of $2,000, making that $59,000. So I'm going to go ahead and skip 2 lines and add in that credit to our accounts receivable since that is getting paid off here for $59,000 in order to get rid of that AR balance from our books. And again, the way we get rid of AR is we need to lower it, which means we're going to credit the asset. So now we're going to find out why I skipped these first 2 lines. So we're going to pop open our calculator because remember, the credit terms here said that if they pay within, how many days was it? Within 10 days that they get 2% off. So that is their discount. And let's see if they qualify for that discount. So the sale was on the 1st, and then they are paying within 10 days because it is August 10th. And that again is on the amount that they owe. So it's that $59,000 left in our AR that we're taking out times 2%, so 0.02%, and that's going to give them a $1,180 discount. And when we do the selling and we offer a discount, we want to keep track of that. So that goes into an account called sales discounts. So you might be asking, well, why are we debiting that? Well, let's go back over here to our contra revenues. Contra revenues are down here. So we now have to record more sales discounts or less. We have to record more sales discounts. So this is why it is a debit. So we will put in sales discounts as a debit here for that 1,180. And now we need to figure out how much they are going to pay us in cash here to balance this transaction. So that is going to be another debit. So 59,000. Then we're going to subtract out that discount because then they owe us less. So that 57,820 is the amount of cash they're going to receive. So that now means our debits equal our credits at 59,000 on each side. And that is again why we also had to put the debit here on the sales discount side and the cash side. And let's go ahead and check our answer. Fantastic. And to quickly review, if you had put that sales discount on the credit side, the transaction would not have balanced. So that is another reason we debit sales discounts.